And here's the part nobody is talking about. Silver didn't simply fall, it was forced lower. And the entities behind this move aren't trying to get out of silver. They're trying to get positioned before the real move begins. Let me show you the proof. On January 30th, 2026, COMEX reported a massive one-day withdrawal of physical silver from registered vaults. More than 3 million ounces were pulled in a single day. That's not profit-taking. That's accumulation masquerading as inventory movement. Because when price is collapsing while physical metal is disappearing, it tells you one thing very clearly. The paper market and the physical market are no longer aligned. Someone is suppressing price with paper while quietly taking delivery of real metal. And that divergence is setting the stage for an explosive short squeeze. Here's why this matters. COMEX registered silver inventories have now declined for 9 straight months. We're sitting at the lowest registered levels since 2016. That's a decade-long drawdown. At the same time, industrial demand for silver has surged. Photovoltaic solar production alone consumed more than 161 million ounces of silver in 2025, and projections for this year exceed 210 million ounces. And that demand is accelerating, not slowing. Every single solar panel requires roughly 20 grams of silver. There is no substitute. There is no alternative material that offers the same conductivity and efficiency at scale. So when you see price collapsing while physical inventories vanish, you're not watching a bear market. You're watching the setup phase of a supply crisis. Now let's talk about who's behind this move and why they need silver prices lower right now. Over the last 18 months, the largest buyers of physical silver have been sovereign wealth funds and central banks across Asia, particularly in China, India, and the Middle East. These institutions are actively converting dollar reserves into hard assets. And silver, relative to its industrial importance, is one of the most undervalued hard assets on the planet. Silver is currently trading at a gold to silver ratio near 56 to 1. Historically, that ratio averages closer to 65 to 1 during stable conditions. But during periods of financial stress, that ratio compresses dramatically. In the 2011 silver rally, it fell to 32 to 1. During the March 2020 panic, it briefly exploded to 125 to 1 before violently reversing. What we're seeing now is intentional price suppression ahead of a major accumulation window. The players driving the paper price lower aren't retail traders. They're institutions with balance sheets measured in the tens of billions. They need physical metal at scale, and they're using the futures market to engineer the conditions required to get it cheaply. Here's how the mechanics work. A large institution dumps thousands of silver futures contracts during low liquidity periods, typically overnight or just ahead of the New York Open. The objective isn't to profit from the short. It's to trigger stop-loss orders and algorithmic selling. Once that cascade begins, price falls rapidly, retail panics, margin calls force liquidations, and while paper contracts are being dumped, the same institutions are quietly buying physical silver in the spot market at artificially depressed prices. This isn't speculation. This behavior is documented. In April 2020, J.P. Morgan was fined over $900 million for spoofing precious metals markets using this exact tactic, placing massive sell orders to move price, canceling them, and accumulating physical metal simultaneously. It was the largest CFTC fine in history. The strategy didn't disappear. It evolved. Now here's where this becomes critical. The amount of silver available for physical delivery on COMEX is shrinking faster than at any point in the last decade. Registered silver, the only category eligible for delivery, now sits just above 77 million ounces. That sounds large until you compare it to open interest. COMEX silver futures represent more than 890 million ounces of paper claims. That's roughly an 11 to 1 leverage ratio. For every 1 ounce of real silver, there are 11 paper claims. And here's the problem. If just 10% of contract holders demand delivery, the system fails. COMEX cannot deliver, price discovery collapses, spot prices decouple from futures entirely. That's the trap being set right now. Now look at the physical market. While the paper price is being crushed, premiums on physical silver have been rising steadily since mid-January. American Silver Eagles are trading $6 to $8 over spot. 12 to 15% premiums in many markets. Canadian Maple Leafs show similar spreads. Even generic silver rounds, which normally trade $1 to $2 over spot, are now commanding $4 to $5 premiums. That's a fourfold increase in premium in under 3 weeks. This is not normal behavior. Rising premiums alongside falling spot prices mean physical buyers don't believe the paper price. They're willing to pay well above COMEX quotes because they understand physical silver is both undervalued and undersupplied. When that divergence widens enough, the paper market loses credibility entirely. And when price discovery shifts to the physical market, the repricing is not gradual, it's sudden and violent. Now let's look at what the banks are doing. The 4 largest bullion banks currently hold a combined net short position exceeding 150 million ounces of silver on COMEX. That's more than double their average short exposure over the past 5 years. And they aren't hedging mine output. Most silver miners don't hedge. Around 70% of silver production comes as a byproduct of copper, lead, and zinc mining. Those operations don't hedge silver because it's not their primary revenue stream. So if the banks aren't hedging production, what are they doing? They're suppressing price to cover legacy shorts and accumulate physical metal before the reset. This is the same playbook used in 2008, 2011, and 2020. Suppress paper prices, accumulate physical, allow the system to break, then ride the repricing higher. Here's the part that should concern every retail investor. When the squeeze begins, it won't be a slow grind, it will be a gap event. Silver will open 10, 15s, even $20 higher overnight. Futures trading will halt. Spot prices will decouple completely. And anyone waiting for confirmation will miss the move before it even appears on mainstream media. This isn't speculation, it's pattern recognition. Look at 2011. Silver started the year around $20. By late April, it hit $40, a 70% gain in 4 months. But the move didn't unfold smoothly. It came in 3 explosive bursts, each triggered by delivery stress and vault drawdowns. The final surge from $42 to $49 occurred in just 9 trading days. And when it peaked, the collapse was just as violent. But the investors who understood the setup weren't trying to time the top. They accumulated physical silver in the 20s and held through the volatility. When silver later stabilized in the mid-30s, they were still sitting on massive gains. Today, the fundamentals are even stronger. Industrial demand in 2011 was a fraction of what it is now. Solar was minimal. EVs weren't mainstream. 5G didn't exist. Silver was primarily monetary. Today, silver is a critical industrial input for the global energy transition, and supply is falling behind. Global mine production in 2025 totaled roughly 822 million ounces. Total demand exceeded 1.05 billion ounces. That's a 230 million ounce deficit. That gap is being filled by above-ground stockpiles, recycling, and vault drawdowns, all of which are finite. Industrial demand is inelastic. You can't make solar panels, EVs, or advanced electronics without silver. Governments have committed trillions to these projects. Demand doesn't stop because price rises. Only price can adjust. Now layer in geopolitics. The BRICS nations, along with new members like Saudi Arabia and the UAE, are actively building a commodity-backed trade system outside the US dollar. Silver is one of the assets under consideration. Why? It's universally recognized, industrially essential, and impossible to print. If even a small portion of global trade begins settling in commodities, silver demand explodes overnight. And the U.S. has zero strategic silver reserves. The national stockpile was liquidated by 2005. Meanwhile, silver is classified as critical to national security. Missiles, satellites, radar systems all require silver. There is no buffer. Now zoom out. Copper is breaking highs. Lithium is stabilizing. Nickel is tightening. Rare earths face geopolitical pressure. Every critical commodity tied to the energy transition is rising, except silver. The one with the worst deficit just got crushed. That doesn't happen by chance. This crash wasn't random. It was engineered to buy time, to accumulate, to transfer metal from weak hands to strong ones. If you don't own physical silver, this pullback is your window. Not because price can't go lower, it can, but because the risk-reward is asymmetric. You risk downside. You gain exposure to a structural repricing. But only if you own physical metal, not ETFs, not futures, not paper claims. Physical silver in your possession or fully allocated storage you control. The setup is here. Inventory is draining. Premiums are rising. Demand is accelerating. Supply is constrained. Smart money is accumulating. The only remaining question is whether you'll be positioned before the reset or watching it unfold from the sidelines.